never slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this.
For several decades, companies have been trying to discover a cure for Alzheimer's disease, but without success. In the past few years, two pharmaceutical companies, Elon and Wyeth, have been collaborating to test a drug called BOPI. Dr. Gilman played a crucial role in this second phase, serving as the head of patient care. In this speech, he intends to announce the results of this trial. Cohen is the owner of a large and important hedge fund in America called SAC Capital Advisors. We won't trouble ourselves with too many statistics and figures. At 76 years old, he suffers from lymphoma and had just returned from chemotherapy. He said, "I'm bald like a villainous scientist from Indiana Jones movies. It's not good for me to give a speech or be the face of the company." However, officials from Wyeth insisted that he himself must speak. I didn't completely understand what happened in the movie The Big Short either. The mechanics are as follows. Suppose you own shares of a company whose price I know is going to fall in a month. He said there's no precise Persian equivalent because their core business is shorting. And since shorting doesn't have an equivalent, hedge funds don't either. In short, hedge funds are a type of highly specialized, shadowy financial investment institution that employs very advanced mathematical techniques and engages in high-risk, high-return activities. For this reason, ordinary people are not allowed to invest in hedge funds, and hedge funds are not allowed to advertise. Only super-rich individuals can invest. You must have at least $1 million in wealth or an annual income of $250,000 to even be allowed to put your money into a hedge fund. This means they don't want ordinary people to play high-risk games with the dangerous work they do. These are complex financial market players who use very advanced computer and mathematical techniques and also have all the methods at their disposal. I will put a longer edited audio file of Hamid's explanations where he describes in more detail what a hedge fund is and how shorting works on the blog so that anyone who wants to can listen to it there. My guess is that it will probably fall. Of course, we are all talking about something hypothetical because no one can predict the future correctly. The method of shorting, and I am simplifying it greatly, is like this. I come to you and say, "Will you lend me your shares? Lend me that share certificate for a month. I'll give you something for it, like a kind of rent, so you'll be happy." I borrow your share certificate today and immediately sell it in the market for $50 or 50 tamans at today's price. I owe you one share, but I told you I would return it in a month. I predict that in a month it will be 40 tamans. If my prediction comes true, I will buy it back for 40 tamans and give it to you. I'll say, "Here, take what I borrowed from you last month. I lent you this thing, and I gave you a small rent saying, 'Give it to me, you who want to.' Suppose you are a long-term investor. I say, 'That's something sitting in your fund gathering dust, give it to me for a month. I will give you rent for that month, and you will also profit from this.'" This is what they were doing in the movie The Big Short. This is the concept of what they mean by how they were shorting. This is one way of shorting. So I asked a friend, "Should I explain this?" "Yes, let me explain." Shorting in Persian means short selling. I am Hamd Gaddousi, an assistant professor of financial economics at Stevens Institute of Technology near New York City. Mathematically speaking, shorting means that instead of being happy when prices go up, you're happy when prices go down. This is the conceptual level of the movie, and it's a conceptual secret. He is a highly respected and well-known individual, at least in his professional sphere. For years, he held a chair in neurology at the University of Michigan in Ann Arbor, where a training course and a university building were named after him. He is a scholarly person with a 3-page CV. and his presence as the person in charge or the face of a new and emerging drug is very reassuring for listeners and viewers. He invested close to $500 million in BAPI. Steve Cohen's reputation was built on profiting from catalytic events. It seemed that BAPI reduced disease symptoms in some patients but not in others. Gilman, however, remained optimistic about the results and stated that their data looks promising. In the capital market, investors listen to words meticulously and read between the lines. Their conclusion after this speech was that they were not very hopeful about the drug's financial future. One analyst, after the speech, summarized it in one word: disaster. This means that if the results Mr. Gilman is about to present in his speech are promising, the value of these companies' shares will significantly increase and Cohen will make a substantial profit. He founded this company in 1992. A hedge fund is, for example, an investment management company. We will explain exactly what a hedge fund is and what it does in more detail later. What we need to know now is that he started this hedge fund in 1992 with $25 million in capital and, within 16 years, turned it into a $14 billion empire with over 1,000 employees. They have very wealthy clients who entrust their money to the company for investment. It seemed that Steve Cohen had made a historical mistake. The next day, when the market closed, Elan's shares had fallen by 40%, and Wyeth's shares had fallen by 12%. However, when Gilman began his speech, Steve Cohen's SAC hedge fund held no shares in either of these two companies. In the 8 days leading up to the conference, the company had sold all of its $700 million in shares in both companies. Then, it shorted the shares, meaning it bet against them, and in the process, earned $275 million in profit. Within a week, Cohen had bought back the same shares, regaining his position as a holder of a significant percentage of the company's shares, this time with approximately $1 billion in capital. This type of betting, or shorting, might be something you've seen in the movie The Big Short. The company charges a very, very high commission compared to its competitors, but its returns are such that, after deducting all administrative and overhead costs, investors, on average, earn over 30% annual profit. Alzheimer's is a very important issue affecting 5 million Americans. It is predicted that as the American population ages, the number of people afflicted will significantly increase. It is also a significant issue in other parts of the world, which is why Alzheimer's research has gained urgency and priority in recent years. Clinical trials indicate that this drug may genuinely halt the progression of cognitive decline or dementia. If an effective drug emerges that eliminates the consequences of Alzheimer's, there will be a very robust market for it. Just as these two companies, Elan and Wyeth, are investing hundreds of millions of dollars in the research and development of this drug, investors are wondering if BAPI could be the next Lipitor. Some time ago, the journal Barron's published a report about it, featuring on its cover the biggest drug in history, generating a lot of buzz. In short, among investors, there was a particular shareholder who bet a lot of money on BAPI's success. The trials on mice were meticulously organized. The initial phase of treatment, conducted on a small number of human subjects, also showed improvement in their conditions. Now, the second phase of the trial, involving Davis and 40 patients, is nearing completion. Another interesting development is that investors have become very interested in this issue. In the 2 years leading up to this conference, a billionaire named Steve Cohen purchased hundreds of millions of dollars worth of shares in these two companies. His company held shares in over 1,000 companies, but in 2008, its largest holding was in Wyeth, and its fifth largest holding was in Elan. Gilman himself was not very keen on giving this speech. The Big Short, however, shortly after the start of his 13-minute presentation, it became clear that the trials conducted on BAPI had not been entirely successful. The Chicago conference, in fact, turned out to be a catalyst for anguish, but not the kind of catalyst investors expected that would cause an immediate surge in stock prices. If you didn't quite understand what happened here, it's probably because who am telling you the story, didn't fully grasp it either. So we need such a facility for buying and selling. How does it happen in reality? It's very simple. Besides shorting, I also asked Hamd about hedge funds, what they are exactly, and what their proper Persian equivalent is. He said there's no precise Persian equivalent because their core business is shorting, and since shorting doesn't have an equivalent, hedge funds don't either. In short, hedge funds are a type of highly specialized, shadowy financial investment institution that employs very advanced mathematical techniques and engages in high-risk, high-return activities. For this reason, ordinary people are not allowed to invest in hedge funds, and hedge funds are not allowed to advertise. Only super-rich individuals can invest. Now, after this several-minute introduction, let's delve into the story and see who Cohen is. The details of these trials were also confidential. Nevertheless, Sack had predicted them exceptionally well. Cohen used to say that he made most of his decisions in the stock market based on his gut feeling. Gilman studied medicine at UCLA, then taught at Harvard and Columbia, and in 1977 became the head of the neurology department at the University of Michigan. GLG's business was brokerage. They acted as intermediaries between investors and expert consultants in specific scientific fields, people who could answer investors' specialized questions. When he started receiving these consultation fees, his annual income gradually became several $100,000. However, those around him did not notice any particular change in his lifestyle, and said that he had recently joined Sack Steve Cohen's hedge fund and was working on healthcare stocks. They talked a bit about Alzheimer's treatment and specifically about the drug, Bopi. Although Martoma did not have a medical degree, he seemed to understand the complexities and intricate issues involved in the work. Both his wife and mother were doctors, and he himself had been interested in Alzheimer's since childhood. For a while during his school days, he had volunteered at an ophthalmic hospital. This is a system that exists in some countries where people, while in college or high school, volunteer at a hospital for a period. Depending on the hospital and the person, these tasks can vary greatly, from sterilizing instruments to administrative work, archiving, admissions, or educational support, and other auxiliary services. It's also possible that it's something like a research assistant. We don't know exactly what Martoma did, but he worked in the Alzheimer's ward of the hospital. He wore stylish clothes as always, but his life was not extravagant, and he always advised all his students to avoid situations that might raise accusations. He told them not to do anything that would even raise the suspicion of a conflict of interest. He also always said that he would never invest in pharmaceutical companies, and later, regarding the consulting work he did, he said that it was a side job for him, more of a hobby. The company founder's idea was that these hedge funds gathered a lot of highly valuable information for free by pleading with this person and it shouldn't be like that. I want to be the intermediary who takes information from the knowledgeable expert and gives it to the person who needs it, and money should also change hands as it should. They offered Gilman to become an hourly consultant for the company, proposing a consultant fee of $1,000 per hour. Many others received and accepted such a significant offer. In 2005, it is said that 10% of physicians in America had some kind of relationship with the investment market. This 10% figure was 75% higher than in 1996. This is probably considered the most severe growth rate of connections between medicine and academia in history. He moved to Ann Arbor, a small university town, with his wife and 2 sons. In the early 80s, his marriage fell apart. Then his eldest son developed mental health problems and committed suicide in 1983. Gilman had of course, experienced family tragedies before. When he was a child, his father had left them, and his mother later committed suicide. For this reason, these family tragedies had become a part of his personality. After his son's death, it seemed that Gilman threw himself into his work, trying to cope with his grief and sorrow by distracting himself with work. However, shortly after his son's death, he married a psychoanalyst named Carol Barber. Although they did not have children, his relationship with his other son from his first marriage, who was still alive, completely broke off after some time. This relationship ended, but throughout these years, he had become like a father figure to many residents and young colleagues. He was very supportive of young people and helped them in a way that people holding chairs at that level usually didn't. They say he truly had an amazing intuition that allowed him to look at the stock ticker and intuitively know where it was going. He's a very strange and unusual person. Some say he's the greatest stock trader history has ever seen. You must have at least $1 million in wealth or an annual income of $250,000 to even be allowed to put your money into a hedge fund. 3 years after the Chicago conference, in December 2012, an indictment was issued for a young man named Matthew Martoma who worked as a portfolio manager for Cohen. The accusation was that he had used confidential information about Boppy and executed the most profitable stock market trade in history. That is, the most profitable insider trading in history. Insider trading, in a very brief and simple sense, means trading stocks using information that is not public. This is illegal, at least in America. The indictment stated that Martoma, over 2 years, received confidential details about the progress of the drug's clinical trials and, based on that information, quickly realized that the results of the second trial would be disappointing. He then decided to trade accordingly. His source of information was none other than Sid Gilman. This means they don't want ordinary people to play high-risk games with the dangerous work they do. These are complex financial market players who use very advanced computer and mathematical techniques and also have all the methods at their disposal. I will put a longer edited audio file of Hamid's explanations where he describes in more detail what a hedge fund is and how shorting works on the blog so that anyone who wants to can listen to it there. The story of SAC Capital well, we've learned what shorting means, and we've understood the meaning of a hedge fund. Gilman, the doctor who gave this speech, and Cohen had never met before. However, government officials had a different explanation for SAC's clever maneuver. Now, let's briefly look at who Gilman is. One day in 2002, a physician named Edward Chin contacted Gilman on behalf of a company called Gerson Lehrman Group. Gilman's salary at the university at that time was $320,000 annually, which is a lot of money for living in Ann Arbor, that small city. One can live a good life there with that money. Matthew Martoma, in the summer of 2006, a young man named Matthew Martoma called Gilman and said that he had recently joined Steve Cohen's hedge fund and was working on healthcare stocks. They talked a bit about Alzheimer's treatment and specifically about the drug Boppy. SAC was a difficult place to work. Its headquarters in Stamford was a strange office. Artworks from the personal collection of the owner, Steve Cohen, decorated the company. Among the artworks in the office was something called Self by the artist Mark Quinn. He was living in Boston at the time and was happy working for a small hedge fund. He knew SAC and understood that working for them was all or nothing. Finally, he agreed to work there. SAC's success depended on its portfolio managers having first-hand and fresh ideas. It's about how they have access to these things, how they get edge, how they have more edge than others, or more trump cards. He also gives all his people the necessary tools to get ahead of competitors in acquiring these trump cards. The company rule is eat what you kill, meaning whoever gets the trump card has no incentive to share it with others. However, if someone has a good idea, They share it with Cohen himself. His parents were Christians who had immigrated to America from southern India in the 1960s. His father was a strict, harsh man with a pointed nose and a trimmed mustache. He put a lot of pressure on his son to climb the ladder of success and achieve things. Matthew obeyed. His grades in school were excellent. Even as a student, he started a small business for himself, a lawn mowing company where he didn't do the work himself but outsourced it to other children. He was also the eldest son in the family and seemed to be perfectly embodying the family's desired standards. Portfolio managers send an email summarizing their ideas every Sunday to an address called Steve's Ideas, listing their promising leads and indicating the probability of success for each. In a competitive market full of different hedge funds, it is very difficult to find an idea that no one has explored before. For example, they had a contract with a company full of former CIA officers whose job was to constantly monitor all speeches, statements, conference debates, and comments from company CEOs to see if they were hiding anything. A company full of CIA officers did this, and Steve Cohen's employees, the hedge fund people, had access to their information. He contacted GLG and gave them a list of 22 doctors he wanted to speak with. Most of these individuals were involved in the drug's trials. Most of them declined the offer, citing conflicts of interest because when they work, they sign a confidentiality agreement that makes all information about the progress of the work confidential, and they are not allowed to discuss it with anyone. However, Gilman accepted, although in his reply, he also wrote that he would only provide publicly available information. Nevertheless, he accepted the offer. The Sunday after his first conversation with Gilman, Martoma suggested in his email to Cohen that they buy 4.5 million shares of Elon, and stated his high level of confidence because they had a contract with this company and received services from them. Or, for example, the contract they had with the GLG consulting firm was like a buffet where you pay a fee and eat whatever you want. Similarly, they had unlimited access to all the consultations from that company. In this business, they refer to very detailed and at the same time very crucial information as Edge. The Persian equivalent is roughly trump card, although it doesn't carry all the different meanings of Edge, and therefore doesn't convey the same impact. An American judge involved in many cases related to this kind of work says that to find an edge or a trump card. These hedge funds might even send someone to China to sit in front of a factory and see if the factory is working 2 shifts or 3 shifts a day, all to get an edge. They gave their portfolio managers a lot of money to trade. If their investments paid off, they became very rich very quickly. If not, they were quickly fired. Their contracts had a down and out clause, meaning the rule there was you either shine or you die. Cohen always likened his brokers to athletes. He even hired psychologists for them who had previously worked with Olympic athletes. These psychologists would work with the employees several sessions a week to help them overcome their fears and master them. In short, he hired experienced people who could withstand pressure. This is a strange piece. I recommend you Google it to see it. In any case, he had studied bioethics, then worked at the National Institutes of Health, where he published an article on Alzheimer's research. He was later accepted to Harvard Law School, but a year later, during the dot-com bubble, he left the university, like many others in America at that time, to start a startup. He then went to Stanford, where he earned an MBA, and after that, he went into the line of work we mentioned. It doesn't have much to do with the story, but since I saw it myself, it was interesting, so I'll briefly describe what it is. It's a sculpture of the artist's head made of frozen silicone, and the artist used his own blood in it. The sculpture is frozen, meaning it must be kept cold in a glass refrigerator, and because it contains blood, its color naturally changes over time. It's a very strange and interesting work. Although Martoma did not have a medical degree, he seemed to understand the complexities and intricate issues involved in the work. Both his wife and mother were doctors, and he himself had been interested in Alzheimer's since childhood. For a while, during his school days, he had volunteered at an ophthalmic hospital. This is a system that exists in some countries where people, while in college or high school, volunteer at a hospital for a period. Depending on the hospital and the person, these tasks can vary greatly, from sterilizing instruments to administrative work, archiving, admissions, or educational support, and other auxiliary services. It's also possible that it's something like a research assistant. We don't know exactly what Martoma did, but he worked in the Alzheimer's ward of the hospital. In their first conversation, Martoma and Gilman spoke for over 2 hours, and after that, Martoma asked GLG to schedule another consultation with Gilman. This work, along with other artworks, is on the same floor of the company where the traders and stockbrokers sit. The air conditioning is always on, and the air is always very, very cold. Employees are given fleece jackets with the company logo to wear in the office so they don't freeze and can work. The company environment is very quiet and low noise. Phones don't ring, they only blink when someone is on the line. Quiet music is always playing. Cohen sits in his office behind a round table with a constellation of different monitors in front of him. From there, he gives commands on what to buy and what to sell. There is also a camera on him through which he talks to his people and gestures with his hands. Cohen himself does not have a very comfortable appearance. He looks pale, and when he laughs, his crooked teeth show. In almost every photo you see of him, he looks like this. But in the camera's image, he appears powerful. SSC culture. When Martoma first joined SAC, he was a little hesitant. Martoma had studied bioethics at university, which involves philosophical studies of controversial ethical issues arising from human progress in sciences such as biology and medicine. The offer from this company came, and he visited them one day, toured the office, observed Cohen's work, and looked at the company's monitors. When Cohen was asked about Hedge, he once said, "I hate it, but all of his company's advertising is based on it." Martoma himself was always very eager for research. At SAC, he was very satisfied and happy with the facilities and resources the company provided him. The conspiracy. From the very first days, Martoma became interested in BOPI and its potential. Martoma, whose real name is Ajay Matthew, was born in 1974 and grew up in Florida. His parents were Christians who had immigrated to America from southern India in the 1960s. His father was a strict, harsh man with a pointed nose and a trimmed mustache. Now his dream was for his eldest son to one day go to Harvard. Gilman himself later said that this period was one of intellectual seduction. Martoma had arranged to meet him at the company S office and had said that he only wanted the two of them to be present. The meeting was around lunchtime. When Gilman arrived, he saw a row of sandwiches prepared for lunch. He says, "Of course, I didn't realize at the time that he was trying to obtain confidential information. At first, I gave theoretical answers, but then he insisted so much and put so much pressure that the information slipped out, and what happened, happened." He told him which patients experienced which side effects, and he says that several times during the conversation, Martoma asked him to speak more slowly so he could write down the numbers. Martoma was a very warm and jovial man, broad-shouldered with long, very short black hair, and something in his face that gave him a cat-like quality. It's visible in his photos too. Cohen, of course, had been the subject of such rumors since he started his business. Once, early on, a small broker was after him, but he escaped, meaning no charges were filed against him. Then, in the 90s, when he became famous, all analysts said that he had a pebble in his shoe, meaning his competitors said that he couldn't be playing by the same rules as them. Because if that were the case, how could he win in this market? How could he have such high returns on investment for such a long time? Surely he was doing something shady. In 1942, the real president of a company gave pessimistic news to shareholders to encourage them to sell their shares. Then he bought their shares at a low price, and what he knew and others didn't was that the company's income would quadruple next year. That is, he had an edge, a trump card. After that, this act was called insider trading and was prohibited. However, for a decade after that, there was still debate about whether this law was right or wrong. Some also said that it was a victimless crime and therefore its perpetrators should not be pursued too strictly. Many in the financial markets agreed with this, even if only in their hearts. For this reason, the law was enforced somewhat inconsistently. According to Gilman, their interaction was very, very friendly. He greatly praised and thanked him for the previous consultations, and this was how they met for the first time. He said that insider trading had become a widespread phenomenon, especially in hedge funds. The widespread nature of this trading meant that if you didn't get caught, the profits were tremendously significant. And if you did get caught, the punishment was negligible in comparison. He also said that these people, whose job it is to evaluate risk, make their living by evaluating risk. They sit and calculate, well, if I get caught, the penalty is, for example, this much in fines. They calculate and say, it's worth it. Now, this person's strategy was to bring prison into the equation and complicate it for them. They talked for hours about trials on various Alzheimer's drugs, and he says that whenever he talked about a clinical trial, he saw that this young man had good information about it. The more he told him, the more he absorbed, and he said to himself, I wish my students were as curious and thirsty for learning as he is. However, when Martoma graduated from high school, he went to Duke University, which greatly disappointed his father. On his 18th birthday, his father gave him a plaque engraved with "The boy who ruined his father's dreams." Gilman, of course, also provided services to other clients during this period, and Martoma also spoke with other doctors, but none of them had a relationship of this extent, or even close to this extent, with anyone else. In Gilman's view, Martoma was truly interested in the issue of curing Alzheimer's beyond just an investment. He even recounts that when he said that certain things needed to be done with patients, Martoma used the pronoun we, saying we need to do such and such with this drug. Gilman also gathered the impression that Martoma wanted to befriend him. After the meeting, they went to a coffee shop where Martoma told him about his family, his Indian heritage, and how he and his wife had children one after another. In their emails, he also spoke more intimately with Gilman. Gilman, of course, addressed him informally, but Martoma always referred to him as Dr. Gilman. While in college, he went to Duke University Alzheimer's department and gradually became interested in medical ethics and bioethics there. He then went to Stanford Business School to pursue his MBA and met a girl named Rosemary Kurian. This woman was a pediatrician from New Zealand and was very beautiful. She was studying for her board exams at the time so she could practice in America. She had grown up in a broken family and had not dated anyone before. Their situation was close to that of the Christian family from southern India from which she came. He says that Rosemary was very lovable and also greatly respected his parents. Both parents approved of their relationship, and in 2003, they got married. When Martoma moved for his new job, they already had one child, and Rosemary was pregnant with their second. She had quit her job but was very supportive of her husband's career advancement. He says that Martoma was not just an employee. He worked constantly, 24 hours a day, 7 days a week. He would wake up at 4 in the morning to keep up with the healthcare market in Europe and would work non-stop until the New York market closed. Then he would spend a few hours with his children. When the children went to sleep, He would do another shift working on his laptop in bed while Rosemary was, for example, sleeping next to him. He had several prospects, but Boppy was the most important and promising of them all, and after a while, he became completely absorbed in these stocks. He put a lot of pressure on his son to climb the ladder of success and achieve things. Matthew obeyed. His grades in school were excellent. Even as a student, he started a small business for himself, a lawn mowing company where he didn't do the work himself but outsourced it to other children. He was also the eldest son in the family and seemed to be perfectly embodying the family's desired standards. When his father came to America, he had been accepted to MIT, but he couldn't afford it and didn't go. In the fall of 2006, Martoma had several consultation sessions with Gilman. In October of that year, Gilman was going to New York for some work. GLG documents show that these two had 42 consultation sessions over 2 years. Gilman then recalls the exact moment in his testimony, when Martoma repeatedly asked him about the side effects of the drugs under trial, the side effects that these drugs might have on patients. Now, let's give a brief history of one of the rules of the American stock market. The fall of Cohen. However, in 2009, a new U.S. attorney arrived in the Southern District of New York, which includes Wall Street, and he stated that he wanted to resolve these debates. After he started collecting statistics, he quickly realized that a nest of corruption was in Stanford and at Steve Cohen's company. Cohen, of course, had been the subject of such rumors since he started his business. Once, early on, a small broker was after him, but he escaped, meaning no charges were filed against him. Then, in the 90s, when he became famous, all analysts said that he had a pebble in his shoe, meaning his competitors said that he couldn't be playing by the same rules as them. Tell us some of the riskiest things you've ever done in your life. In the fall of 2007, he continued to buy more and more shares of Elin and Wyeth, and Cohen himself gradually began transferring money from his personal accounts to Martoma's portfolio. Cohen's desk also helped because everyone could see that this young man, Martoma, kept going to the boss and whispering things in his ear. They had a portfolio manager who himself had a PhD in neuroscience and was pessimistic about Boppy, stating that Elin and Wyeth had assigned him the responsibility of presenting the results of the second phase of the trials at the International Alzheimer's Conference in July. Martoma quickly sent a consultation request to GLG, stating, for example, that they wanted to discuss several therapeutic topics. Up to this point, Gilman had access to some of the trial results, but his eyes had been kept closed to the very important issue of the drug's beneficial effects. Now, to present the new findings, this blindfold was removed from his eyes. 2 weeks later, Elin arranged a private jet to take him from Detroit to San Francisco, where the company's office was located. He spent 2 days with the company's directors to meticulously prepare his presentation. When he returned, the company officials sent him a confidential email telling him not to share it with anyone. And with this email, they sent him a new and updated version of the 24-slide presentation he was supposed to use. As soon as he downloaded it, Martoma called, and they talked for an hour and 45 minutes. Gilman explained the contents of the file to him, but the issue was too complex to be conveyed orally over the phone. Martoma said, "I'm actually coming to Michigan at the end of the week. A relative of mine passed away, and I was busy and couldn't attend the funeral. Now I want to bring my family." He also disliked Martoma and didn't understand how this person was so confident about this drug. One time, he sent an email to Cohen saying, "Yes, I'm concerned whether Martoma really knows something about Boppy or if he just has a strong feeling that it will be successful." Cohen replied, "Tough question. Don't interfere. Matt knows what he's doing." However, we don't really know how Martoma gained Cohen's confidence. Usually, portfolio managers wrote detailed explanations of their investment ideas in those emails to Cohen. But when it came to Boppy, Cohen and Martoma usually spoke orally. The emails Martoma sent to Cohen were usually one-liners. Do you have 5 minutes? Can I see you for a minute? Can we talk for a minute in the office? In October of that year, Martoma sent an email to Cohen stating that Boppy was going for its third trial. There were other people. Another portfolio manager also raised the same concern. He wrote in an email to Cohen that it was unacceptable to invest $500 million in a drug without really sitting down and talking about it. This was very strange and very dangerous, but Cohen gave Martoma the chance. It's possible that in the early days, Gilman might have accidentally leaked some information, but gradually this became a very systematic process. Whenever Gilman found out that there was a meeting for exchanging confidential information, Martoma immediately booked a consultation session for after that meeting so that Gilman could give him any new information he had obtained. Besides those consultation fees, Gilman did not receive any other money from Martoma, but he very easily, painlessly, and even eagerly violated professional ethics and crossed the line. At one point, Gilman even explicitly suggested that he concoct a false pretext for a meeting so that they wouldn't become suspicious. And this was the largest Alzheimer's treatment program that had ever existed. The company had a computer system called Panorama that allowed employees to see their investments live in real time. Employees constantly checked Panorama, and therefore, they were very aware of the size of the bet that Martoma, as a relatively new portfolio manager, was making. They had also seen that Cohen himself was following this young man's lead. This clearly shows what kind of people they were looking for. These white-collar criminals are usually easy targets for police and judicial systems, people who have not only never been arrested, but most of whom have never even thought about being arrested. They have never imagined spending a day in prison. One of the people in this case, a former employee of Cohen, fainted and fell in court while awaiting the jury's verdict due to the psychological pressure. That's why the FBI first monitors these people who don't think they're under surveillance at ease for a long time. Then, one morning, when the person is getting their morning coffee at a coffee shop, they are confronted with an arrest warrant and a small charge. Then they are told, "Now tell us what else you've done." Their tactic is more or less the same tactic that was used to break down the New York Mafia. The plan is to arrest low-level soldiers, threaten them with long prison sentences, and tempt them to become informants. Information is gathered from them to build a case against the people at the top of the hierarchy. Over time, the organizational chart of this criminal enterprise emerges with information and links, very similar to what we've seen in movies about mafia organizations. They did the same for these people. Because if that were the case, how could he win in this market? How could he have such high returns on investment for such a long time? Surely, he was doing something shady. Cohen is not one of those investors who seek the true value of shares. His style of work involves frequent buying and selling and placing very large bets on short-term changes in share prices. He never develops an attachment to shares. As one of his employees puts it, shares mean nothing to him. He's not an analyst, he just trades. He always trades, and he loves this work. However, his company's business model is in fact based on the active collection of information and rapid, accurate analyses. Later, judicial investigations also showed that the organizational culture not only did not discourage the use of insider information, but actively encouraged it. One of his former analysts says that Cohen once told him, "I can do these stock trades myself. I don't need you guys sitting out there in a row. I want you to go out and get me Edge, bring me trump cards." This person says that after this statement, his feeling was that his boss was looking for illegal information, and if he didn't deliver, he would be fired. It's very interesting that when they wanted to hire someone, one of the questions they always asked was, "At the head of this organization sat Steve Cohen." The office system was an open plan system, meaning there were no walls between employees. Everyone had a desk in the middle of a large hall. When that doctor strongly insisted that these stocks were not secure, Cohen briefly wrote to him that he thought this would be a very big drug. On June 25, 2008, Gilman sent an email to Martoma with the subject, "Some news. I wanted to see them, wish them well, and so on. Could I also visit you if it's okay?" Gilman says, "Yes, come, why not?" 2 days later, Martoma goes to Detroit, takes a taxi from the airport to Ann Arbor, sits and talks with Gilman in his office for an hour, and returns to New York the same day without seeing any relatives. The next day, a Sunday, Martoma sends an email to Cohen saying, "Do you have time to see each other today? It's very important." Cohen sends him a phone number. At 9:50, Martoma calls Cohen's home, and according to court documents, they talk for 20 minutes. On Monday, when the market opens, Martoma and Cohen tell Cohen's broker at the firm to quietly start liquidating their shares in these two companies. They do this using an electronic stock trading system called a dark pool and employ several tricks to make it difficult to trace these transactions. Over the next few days, they sold all their shares in these two companies so discreetly that even within the company itself, no one realized. On July 21st, the broker who was executing the operation wrote to Martoma, "No one knows but you, me, and Steve." Martoma did not tell Gilman anything about the sale of the shares. The following week, he flew to Chicago to attend a conference. As usual for his business trips, he took Rosemary and the kids with him. The next afternoon, while Gilman was still speaking, news of hidden or overt doubts about this report reached the media. Tim, a young broker who worked for Martoma, was sitting in the office, anxiously watching Bloomberg News. At the same time, he was checking the Panorama system. He owned shares in these two companies, and what came to his mind was that at this very moment, Martoma had squandered over $7 million of Cohen's money and had lost his job, so he thought he had also lost his job. The next morning, he reluctantly got ready to leave, but he checked the system. The shares of these companies had disappeared. Shortly after, Martoma told him that SAC did not own any shares in these two companies. Tom was very close to Martoma, working with him every day, so he was very upset that he knew nothing about this transaction. Martoma told him that Steve Cohen himself had decided to keep the sale confidential. Besides these people, even outsiders at the company were baffled as to how SAC had turned a potential disaster into not only avoiding a fall, but also making a profit. As a friend of this same young broker, Tom, who worked at JP Morgan, put it, "This is the kind of thing they write about in books." Later, when Tom told him, without going into details, "I'll just say that this week was very good for us," the young man replied, "Stuff that legends are made of." SAC made a profit of $275 million by selling shares and then shorting them. That year, Martoma received a bonus of $9.3 million. The last time Gilman saw him before they later faced each other in court was the day after Gilman's speech, when Martoma invited Gilman to lunch at a hotel in Chicago. Martoma asked him, "Did you hear what happened to the Elon shares? They collapsed, a free fall." Martoma seemed to think that the drug market, which only helps half its consumers, doesn't like it. Then they didn't hold on to it any longer. A few months later, in September 2008, when the financial crisis had begun, Gilman sent an email to Martoma with the subject, "How are you?" and wrote, "Yes, I haven't heard from you in a long time. I hope you're well and your family is well. And I hope this major market turmoil hasn't affected your shares, especially after that disappointing drop in those shares. Anyway, there's no new news. I just wanted to check on you." Martoma did not reply to this email. New York judicial authorities were constantly monitoring stock market transactions. 6 weeks after the Alzheimer's conference, the unusual activity of SAC caught their attention. They began examining documents and phone call lists, looking for a clue that would show they had confidential information. They went through all their call lists for a year until they found Martoma's mobile number in Gilman's call list, and immediately said, "This is it." Of course, they had been aware of Cohen and watching him for years, but Cohen was a very elusive target. They also said, "Our company's structure is such that these people, the portfolio managers, each have a degree of authority based on which they operate almost independently. This means that even if the police catch low-level people or use threats and inducements to make them inform, it doesn't prove that Cohen was trading based on confidential information, for example." In 2009, they even bugged his house, a 3,000 square meter mansion, but they didn't find anything useful. For a while, they even tried to persuade one of his old employees to work for him again and provide them with information, but Cohen saw through their plan and didn't hire him. The company's legal department told all employees that if there was something they did intend want authorities to get their hands on, they shouldn't say it in a message, email, or voicemail, nothing. This meant their assumption from the beginning was correct. Everything was under control. That's why penetrating their organization was truly difficult and time-consuming. Every time an email conversation between Cohen and an employee reached a sensitive point, Cohen would say, "Let's talk in person." Even more interestingly, even when there was strong evidence showing that he had received confidential information and acted upon it, he and his lawyers would disclaim it with long and strange explanations. Once in 2008, an analyst sent an email about Dell's financial report, which was soon to be released, to two of his colleagues. He said, "My source is someone who got the report from someone in the company." These colleagues forwarded the email to someone else, and it reached one of Cohen's people, who then sent it to Cohen. Then he called Cohen. 2 minutes after this call, Cohen began liquidating the $10 million worth of Dell shares he owned. Despite all this being proven, when this transaction was brought up in court, Cohen's lawyers argued that Cohen's decision to sell Dell shares was independent of this information. Their explanation was that although this email was sent to Cohen's inbox, he probably never read it. He receives almost 1,000 emails a day and sits at a desk with 7 monitors in front of him, and his Outlook email inbox is open on the furthest monitor to the left. Outlook is behind 2 other programs. The email program's window is behind 2 other programs, and the size of his Outlook screen is set so that no more than 5 emails are visible at any given time. For Mr. Cohen to have read this report, he would have to go to his 7th monitor on the far left, minimize 2 programs, scroll down through his emails, find this email, double-click to open it, read the chain of forwarded emails to get to the report itself, read the report, digest its information, and then make a decision based on it. This would take too long. It's impossible that he did this before he started selling the shares. In this case, Cohen's employee was convicted, but Cohen was not affected. Of course, in theory, the other party could have testified against Cohen, but the reality is that no evidence could show that this transaction was truly based on confidential information. Furthermore, that person was an old friend and a longtime employee of Cohen's. He had worked for him for 10 years, and it was very unlikely that he would betray him. But Martoma, in our story, did not have such loyalties. The hefty bonus he received in 2008 was followed by a significant loss in 2009. In 2010, the market was bad, and he was fired, losing his job. Then he moved his family to a coastal city in Florida, where they bought a large house by the sea despite neither of them working at the time, and they focused on their children, who were 3 by then, and on a charity they had founded and invested $1 million in. Then, around November 8, 2011, Martoma came home to find 2 FBI agents at his door. One was a man who had worked on the Cohen case for years. The other was an agent known for always carrying his standard issue weapon and several extra loaded magazines, which is considered overtime for a police officer who tracks and apprehends financial criminals and hedge fund managers. They told Rosemary to go inside, but she said, "No, say whatever you want in front of me." Then the police officer told Martoma, "Do you want us to tell her or will you?" He said, "Say whatever you want yourselves." The agent said, "We know what you did at Harvard." Martoma immediately fainted. What you heard was the first part of a two-part story, Trump Card. This same incident is what we described in the Channel NARRA podcast as the 13th story. If you want, you can find and listen to the second part of the story right now, where you heard the first part because we released both parts simultaneously. Channel NARRA is produced by Ali Bandari with the help of Namlik. I am very grateful to Hamd Gadusi, who is a guest on Channel NARRA. I am very grateful to everyone else who helped prepare this program. I receive a lot of intellectual, advisory, and practical help for each episode, and if it weren't for them, the production of Channel NARRA would take even longer than it does now. I am very grateful to those who introduced Channel NARRA to others. This is a great help, and the number of Channel NARRA listeners is gradually increasing thanks to this word-of-mouth advertising. Thank you. Follow Channel NARRA on Twitter, Facebook, and Telegram to stay informed about new episodes and to receive supplementary news and content about stories we've told before. Channel NARRA Podcast.